Great to be with you, Valentin.
So today we're going to be talking about some of James's core topics: Federal Reserve, gold, maybe a bit of China if we have time. So why don't we start with the Fed, since they're meeting tomorrow, Wednesday?
Well, the analysis with the Fed is very straightforward. Obviously, they're going to raise interest rates 25 basis points on Wednesday. Janet Yellen, the chairman of the Fed, will do her press conference in the afternoon, I think around 2 o'clock. She comes out. They have the so-called dots, which are the projections of the members of the Board of Governors and the Regional Reserve Bank presidents as to their expectations of interest rate levels going into the future. But the real news coming out of the meeting will be what they have to say about balance sheet normalization. Before the last financial crisis in 2008, the Fed's balance sheet was about $800 billion. Today, it's $4.5 trillion. That's how much money they've printed. When they print money, they do it by buying bonds from the primary dealers, and the dealers deliver the bonds, and the Fed pays for it with money that comes from thin air. But then the Fed owns the bonds, so they've got this bloated balance sheet. Now, what the Fed is trying to do, they're trying to prepare for the next recession. They're not predicting a recession. They never do. The Fed never sees a recession coming, but they know a recession will come sooner than later. This expansion is 92 months old. It's one of the longest expansions in U.S. history. It's also the weakest expansion in U.S. history. A lot of people say, what expansion? It feels like a depression to me. I think that's the right way to think about it. I think it is a depression defined as depressed growth, and we have growth, but it's below trend. Trend's sort of 3.5, and growth is 2. That output gap between, say, 3.5 and 2, that's depressed growth. So I'd say we're in a depression, but we're not in a technical recession, haven't been since June 2009. So it's been an 8-year expansion at this point, but it won't go on forever, and the Fed knows that. So research shows that when the U.S. economy goes into a recession, you have to cut interest rates about 3% to get the U.S. out of the recession. Well, how do you cut interest rates 3% when you're only at 1%? The answer is you can't. You've got to get them up to 3% in order to cut them back down, maybe to 0, to get out of the next recession. So that explains why the Fed is raising interest rates. They raised in December 2015, December 2016, March 2017, now June 2017. That's the 4th rate hike, getting them up to 1%. They would like to keep going. They would like to get them up to 3.5% by 2019. My estimate is they're not going to get there. The recession will come first. In fact, the Fed will probably cause the recession that they're preparing to cure. But be that as it may, that's why they're raising interest rates in weakness. But there's another tool. So let's just say, hypothetically, you get interest rates, they'll be at 1% by tomorrow, and now you go into a recession, and you've got to cut them, research shows, about 3%. Well, you can cut them back down to 0. Well, now what do? You go to QE. QE4. We had QE 1, 2, and 3 during Bernanke and Yellen, so now you could do a new round of QE. The problem is that the Fed's balance sheet is so bloated at 4.5 trillion. How much more can you do? 5 trillion, 5.5 trillion, 6 trillion before you cause a loss of confidence in the dollar. Now, modern monetary theorists, MMT, people like Professor Stephanie Kelton, very nice, very smart lady, very nice lady, by the way, but we just disagree on policy. But Warren Mosler, Paul McCulley, there are a lot of really smart people who think that there's no limit on how much money you can print. Just print money, what's the problem? I disagree. I think there's kind of an invisible confidence boundary. I think the Fed agrees with me. They won't talk about it. No one knows what it is, but you don't want to find out the hard way. So in addition to raising rates so they can cut them, they want to reduce the balance sheet so they can expand it in QE4. So as I say, this is all a matter of getting ready for the next recession. They haven't said anything very specific about how and when they're going to reduce the balance sheet. They've signaled it, they've hinted at it, but I think we're going to hear a lot more specific information. Probably they'll start later this year. And the way they do it, people say, well, are you going to dump all these treasuries? You can't sell $4 trillion worth of treasuries. By the way, they probably do have to reduce the balance sheet at least $2 trillion. So who knows what normal is, but you probably want to get from $4.5 trillion down to $2.5 trillion, maybe $2 trillion. It's guesswork as to what normal is, but somewhere in that vicinity. Well, you can't sell that many treasury bonds. You destroy the market, rates would go up, you'd put the U.S. in recession, the housing market would collapse, and they're not going to. What they're going to do is just let them mature. So let's say 5 years ago, you bought a 5-year note. and you held it the whole time. Well, sometime this year, on the 5th anniversary, it's going to mature. The Treasury just sends you the money. And when the Fed gets money, the money disappears. It's like a mystical act, So the point is, they don't have to sell anything. They just have to wait until the bonds mature. Now, what they've been doing now is you say, well, that's true. Why hasn't the balance sheet been going down? Well, the answer is they've been rolling it over. So when an old 5-year note matures, the Treasury sends them the money. They take the money and buy a new 5-year note, so the balance sheet remains unchanged. So what they're proposing is that when these securities mature, they won't buy a new one, they won't roll it over, and that actually will reduce the balance sheet and make money disappear. It'll reduce the money supply. Now they're saying they're going to do it, very small increments. Who knows, maybe 10 billion a month or 20 billion a month that they won't roll over, so the balance sheet will come down by that much. They say they want to put it on autopilot. They're using the word, they always use jargon, they're using the word background. They said, we're going to run this on background. So while we're over here, raising interest rates or doing other things with monetary policy, this is going to be, humming away on background, like when you have 2 or 3 computer programs open at once and you're multitasking, you're looking at one and the other one's running on background. That's how they think about it. That's nonsense. I mean, they spent 8 years telling us that quantitative easing was stimulative, had portfolio channel effects, but now somehow we're supposed to believe that quantitative tightening has no effect at all. By the way, I don't think they're using the word quantitative tightening. I am. It's the evil twin of QE. So QE was quantitative easing, QT is quantitative tightening. They'll probably call it balance sheet normalization, but I think QT is going to catch on. So they want to run this QT on background, small increments, and pretend that nothing's happening. But that's nonsense. It's just one more way of tightening money in a weak economy, probably cause a recession.
So that's interesting that you say it will cause a recession, because the QE critics have said, yeah, it's nice, the stock market's going up, the bond market's going up, but the economy is not really going. So it hasn't done a lot for the economy. So why do you say that then the QT, which probably will reduce asset prices, why will it cause a recession?
Because of the same portfolio channel effect that worked in QE. This is, as I say, QT is QE in reverse. So, for example, first of all, the economy is weakening anyway. There's a lot of evidence of that. You see disinflation. The Fed has a 2% inflation target. There are a lot of different inflation measures out there. The CPI, PPI, core, trim mean. I don't want to get too technical, but lots of different ways of thinking about inflation. The Fed's favorite way, the one they focus on, is the personal consumption expenditure deflator core, meaning obviously excluding energy and food prices. So PCE core is the one they watch, and their target is 2%. They haven't hit the target. They haven't hit the target in years, but it was going up. It was heading in the right direction. Most recently, it backed off. So March, it was 1.6%. April, it ticked down to 1.5%. We don't have the May data yet. We'll have that soon. It'll be very interesting to watch if that continues, but we're seeing signs of disinflation. Auto sales are down, loan originations are down, inflation is down, meaning we're getting disinflation. Just a lot of signs that the consumer confidence is down, et cetera. So a lot of signs that the economy is slowing down. Anyway, now throw on another rate hike and some talk about future rate hikes, and then QT on top of that, you run the risk of deflating the stock market, and then that's kind of like watching the movie in reverse. So what happens when the stock market goes down? People's confidence goes down. A lot of the bulls point to consumer confidence as a reason the economy is getting better. That's nonsense. Consumer confidence is highly correlated to the stock market. So stocks go up, consumer confidence goes up. That's no surprise. Stocks go up more, consumer confidence goes up more. It doesn't mean that consumers are really spending more or retail sales are booming. It just means that they like their 401ks. But that works in reverse. When the stock market goes down, watch consumer confidence implode. So we have a lot of signs of weakness anyway. As far as the stock market's concerned, it's completely priced to perfection based on the Trump agenda, based on Trump's plans. So November 8th, Trump gets elected, and like a little bit after midnight, 2 a.m. on November 9th, it was becoming apparent that he was going to be the next president. The immediate reaction in the stock market, the Dow Jones dropped 800 points. This is in the futures in the middle of the night. Then Carl Icahn leaves the victory party at Trump Tower, goes out and buys $2 billion worth of stocks. It must be nice to be Carl Icahn. And the stock market went up by the open on the November 9th. market was flat, and by the end of the day it was up, and then never looked back. Now, the Dow Jones, the same is true of the S&P, but I'll just use the Dow Jones. It went up about 1,000 points in November in the expectation of Trump tax cuts. It then went up another 1,000 points in December in expectation of Trump tax cuts. It then went up another 1,000 points in January in expectation of Trump tax cuts. There's only one tax cut. The market went up 3 times on the same tax cut. It was like, oh, well, they're going to announce details, or it's going to be in the president's address to Congress, or there's always a story on Wall Street. But the problem is it was going up based on tax cuts, infrastructure spending. Remember the $1 trillion infrastructure spending, repeal of Obamacare, et cetera, et cetera.
Deregulation.
Deregulation. None of those things have happened. A little bit on deregulation, yes, but there's no tax cut. We haven't repealed Obamacare. There's no wall. There's no infrastructure bill. All the things that Trump talked about haven't happened. Now, will they happen? It's looking very doubtful this year. I mean, people want them to happen, but there's no agreement in the Congress as to what these bills should look like. I mean, actually, at one stage of my career, I was a registered lobbyist. I ran a Washington office. We had a lot of high-powered ex-Hill staff. I spent 2 or 3 days a week up on the Hill meeting with Republicans and Democrats, members and staff. So I know how the machinery works, so to speak. It's not pretty. It is a sausage factory. But I also know that you can't just sit in the White House and pound the table and expect things to happen. That's not how things work, even when your party has the majority. So right now, you only got so many days left. The Congress has a schedule. They only, they have what they call legislative days. These guys women only work like 3 days a week. I mean, they go home to their districts on the weekend. They come back Monday night. They leave Thursday, so they're only working like Tuesday, Wednesday, Thursday as it is. Then they take, they have an August recess. Well, the August recess is like 6 weeks. It's like not a month. It's a month and a half. They'll have a 4th of July recess. So when you boil it all down, there are only so many days to get stuff done. But look at the stuff they have to do. They're having all these hearings on Russia. They have to confirm a new FBI director. They've got to deal with the debt ceiling, which is staring us in the face. Probably hit that in September, which would mean the government couldn't pay its bills or not pay off the treasury bonds. I don't think it'll get to that stage, but they've got to deal with it. Then you've got the budget, the potential government shutdown in October. So these are all the things they have to do. And then you're talking about all this other stuff besides. I don't see it happening. So at what point does the stock market say, well, we priced to perfection based on an agenda that's not happening. Now we need to reprice down. And with the Fed tightening on top of that, it's not a very, very favorable setup. Well, the other thing you hear from the bulls is that, corporate earnings are, year over year are doing great. Well, 2016 was lousy. I mean, it is true, it's mathematically true that 2017 over 2016 year over year earnings are strong. That is a fact. But you look at Wall Street, as usual, they've extrapolated that. I saw an S&P, a chart of projected earnings in the S&P. It was going vertical. It was going like this in 2018, 2019. I don't see that happening with the headwinds that we're talking about. So I don't put much stock in the year-over-year earnings comparison because 2016 was weak. The market's priced an agenda that's not happening. The economy is getting long, and the expansion is getting long in the tooth this week to begin with, and the Fed's tightening. So a lot of reasons to think we'll hit a recession and a major stock market correction by late this summer, August, September, somewhere in there.
Interesting. So the asset not affected, or at least not negatively affected by this stock market correction is one of your favorite topics, gold. How do you think that will do? Well,
I'm surprised gold has done as well as it has given the headwinds. I mean, at least in the short run. So we talked about the Fed raising rates. They raised rates December 2016, March 2017, again tomorrow, June 2017. So normally rate hikes are bad for gold. They tend to make the dollar stronger. We already talked about disinflation. That tends to be bad for gold. And yet gold's been chugging higher. Now, if you go back to right after the election, just before the election, gold was about $1,300 an ounce. Now, after Trump was elected, it plunged a lot. It went down to like about $11.28, $11.30 on December 15th. Part of that was our friend Stan Druckenmiller, who, I said Carl Icahn went out in the middle of the night and bought $2 billion worth of stocks. Stan went out in the middle of the night, this is like in the early morning hours of November 9th, and sold all his gold and let the world know it. So that sent gold, kind of crashing, and it found the bottom. And the reason he gave at the time is kind of interesting. He said, well, I bought gold because I was worried about Hillary Clinton. Like everyone else, he thought Hillary Clinton was going to win. You know, I was running around the week before the election telling people Trump was going to win. I was getting laughed at, you know, but you know, you could see that coming. But a lot of people thought Hillary was going to win, so most people, and or almost everyone. And so he owned gold as a hedge. Well, then once Trump won, he sold all his gold. By January, he was tiptoeing back in the market. He was starting to buy gold again. So the bottom from that reversal was December 15th. It's up 20% since then from that low. But it's a very interesting pattern, Valentin, because it goes up and then it goes down. It goes up and down, up and down. So you have this kind of jigsaw or sawtooth pattern. But it's tracing something that analysts call higher highs and higher lows, meaning every high is higher than the one before, and every low is higher than the one before. So it does go down, but it's not as much as the last time, and then it goes up higher than the last time. Then it goes down again, not as much as the time before, and so forth. So the trend is up, even though you have these zigs and zags. You know, look, nothing's automatic. That could change, obviously, but that pattern has been pretty persistent since December 15th. Gold has, you know, made its way. It got up to 1297 in June 6th. Then it got whacked, you know, 2%. But that was because somebody sold $4 billion worth of COMEX futures. An interesting story there. So you know, gold was going up. It was getting close to $1,300 an ounce. Somebody sells $4 billion of COMEX futures, the notional value of gold. So it's like the impact on the market is like selling $4 billion of gold. But of course, it wasn't gold; it was paper gold. Do you know what $4 billion of gold is? 90 tons. Do you think you could sell 90 tons of physical? If I called my broker and said I want to sell 90 tons of physical, and I said, okay, you're done. Deliver the gold. You can't source the gold. You can't get 90 tons of gold. You'd be lucky if you could get a couple of tons of gold. Global output, all the mines in the world produce a little over 3,000 tons a year. 90 tons is close to 3% of all the output of all the gold in the world with one phone call. So you can't do that in the physical market. There's this whole disconnect between the physical market and the gold futures market. But at least for now, yeah, you can call up and sell all the paper gold you want. But you know, in the end, the physical supply-demand fundamentals and the monetary fundamentals, inflation, deflation, confidence in the dollar, confidence in gold, et cetera, will prevail. They always do. But in the short run, yeah, you can whip the market around with these paper gold transactions. But even at that, with that drawdown about 2.2% over the course of June 8th and 9th, it didn't go down, still not anywhere near the last low. And so my expectation is it's going to turn again, probably tomorrow, probably when the Fed raised rates. There's another interesting pattern there. The last two times the Fed raised rates, gold went straight up afterwards. December 15th, 2016, December 14th, 2016, and March 15th, 2017. When the Fed raised rates, that was a catalyst for gold to go higher. So let's see what happens Wednesday and Thursday after the Fed raises rates again. But it looks set to, you know, turn around, go up, cross the $1,300 mark, maybe go higher from there. So it is on the subtrend. So having said all of that, that's a very positive story on gold with headwinds. But going back to what I said earlier about weakness in the economy, the recession, and the Fed tightening into weakness for the wrong reasons, et cetera, if the economy weakens, as I expect it will, and you see the stock market draw down and the U.S. economy growth slow down and disinflation, you know, take over and inflation metrics go down, the Fed's going to have to flip-flop. Be the 9th time since May 2013, by the way. So my expectations beyond tomorrow is that they will not raise rates in September. Well, they have a meeting in July. Forget it. They're not going to do anything in July. There's no press conference at the meeting. They won't do anything in July. There's no meeting in August. They won't do anything in September. Then there's a meeting November 1st, and they won't do anything then. So you're going to have 3 meetings, July, September, and November 1st, where they don't raise rates. And they're going to have to signal that with what they call forward guidance. And so I don't expect it tomorrow, but I do expect it in speeches and leaks to our friends at the Wall Street Journal, you know, between now and then, by late summer. That's going to be extremely bullish for gold, because as the gold's going up anyway, well, once you send out a dovish signal and say we're throwing in the towel, at least temporarily, and we're not going to raise rates, and you take that the rate hike expectations out of the market, you reprice the market, that looks inflationary at the margin. That's very bullish for gold. So I look for gold to have a very strong second half.
Okay, so now you talk about the short-term price move of gold, which you mentioned a little bit. There's a lot of paper selling. You have written about manipulation of the price, which is why some people, and you have written about that as well, you buy gold as an insurance policy against a sort of tail risk event, against the repricing of most asset classes. So even though short-term trend is positive, with all that manipulation going on, you may not get the full benefits until there's this tail risk event. Is that a correct assessment?
I think that's about right, but there's a 100% chance of the, I don't use the word tail risk because it doesn't correctly describe the system dynamics and the degree distribution of risk. But whether, people say tail risk, black swan or whatever.
For the normal distribution.
Yeah, I use the phrases like, it's phase transition because I use physics to analyze capital markets
for the complex systems,
dynamic systems, but it's all the same thing. It's a shock of some kind or a market collapse, something like 2008 or worse. The odds of that happening are 100% because it always happens. I mean, October 19th, 1987, stocks fell 22% in one day. That would be the equivalent of 4,000 Dow points or 400 S&P points in one day. That's what happened in 1994. You had the tequila Mexican peso crisis, came to right up to the edge of systemic collapse, and Bob Rubin had to go into the Treasury slush fund, the exchange stabilization fund, which by the way came from the profits of steel and gold in 1933. That's another little historical footnote. To bail out Mexico, even though Congress didn't want to. 1997, 98, Asian financial crisis, Russia financial crisis, long-term capital management. 2000, dot-com collapse, NASDAQ goes down 80%. 2007, mortgage crisis. 2008, Lehman. So we know the litany, but the point is every, not quite like clockwork, but every 5, 6, 7 years these things happen. It's been 8 years since the last one. How long do you think we're going to go? So that is, that's a catalyst potentially for much higher gold prices. But honestly, Valentin, I don't worry much about manipulation. I know it goes on, I know how it goes on, and I know why it goes on. And I've spoken to PhD statisticians, expert witnesses, and some of the pending litigation on gold manipulation. I've spoken to a lot of experts in this and done my own research on it as well. But the point is all manipulations fail. Big Jim Fisk and Jay Gould ran a gold corner in 1869 and it failed. There was the London gold pool of the late 1960s, it failed. The US and the IMF under secret at the time, direction of Henry Kissinger, did a gold manipulation in the late 70s. It failed. The United States prevailed on its trading partners, UK, France, Italy, Germany, and Switzerland, to dump gold in the late 1990s, early 2000s. Switzerland sold well over 1,000 tons. The UK sold 600 tons, most of its gold. The IMF sold 400 tons in 2010. So all that gold selling, it failed. Net sales by central banks stopped cold in 2010. There are no net sales by central banks since 2010. The IMF has not sold any gold since 2010. So every one of these manipulations has failed. And let's say China's the new manipulator. Good reason to believe that because they're still buying gold. People say, well, if they're buying gold, why would they want the price to go down? Well, of course you would. If you're in acquisition mode, you want the price to be lower. If you want to sit and destroy the dollar, then you want the price to skyrocket. But right now, China's still in acquisition mode, so they have a motivation to keep the price of gold. But the point is, they all fail in the end. So just get your gold allocation. I recommend 10% of investable assets. Put it in a safe place, keep it out of the banking system, and sit tight.
So that's so much short-term versus long-term price movement. Now, you think of gold as money, I think of gold as money.
Right.
Now we have another contender for money, which has been rising in price quite significantly, which is Bitcoin, up 200%, about 200% this year. Depending on the day, because it goes up 30 or drops 30% every single day.
Well, it was $3,000 yesterday. It's probably $4,000 today. So.
No, actually, it did drop 30% yesterday, and then it bounced back to 2,500 or 2,600. Anyway, up a lot. Obviously, the whole market is a lot smaller than gold. So if you plow $1 billion into Bitcoin, price reacts. So what do you think about the whole concept of this digital currency, Bitcoin?
Well, I separate the blockchain technology from the digital currency, the cryptocurrency Bitcoin. I think blockchain technology is a very bright future. It can be used, it's a distributed ledger. It's an encrypted distributed ledger to record ownership of anything. It happens to be that it's used to record ownership of Bitcoins. If I send a Bitcoin to you, that gets reflected in an encrypted ledger someplace, actually not someplace, all over the place. There are, I don't know how many, maybe million or more computers that maintain this database. You can blow them up or steal them, but there's still one somewhere that has that transaction recorded. So Bitcoin's the currency or the money or the unit of exchange, but the blockchain technology, you can use it for stocks, bonds, real estate, titles to vehicles. You can use it for anything. And so that's a very cool technology, and a lot of people are working on that. JP Morgan, the IMF is looking at it. Blythe Masters, formerly of JP Morgan, commodity traders, is partners with a venture, the Winklevoss twins, others. So there's a lot of cool stuff going on at the blockchain. But let's talk about the currency, the money. I think Bitcoin is money. It's a form of money, but it's not an investment. People go, I'm investing in Bitcoin. Like, no, you're not. You're buying Bitcoin. In other words, dollars, euros, yuan, gold, and Bitcoin are 5 different kinds of money, but they're not investments. They're money. To be an investment, like a share of IBM is an investment. I buy stock in a company. I can look at management. I can look at earnings. I can look at a whole bunch of things and kind of come up with a valuation. If I buy a bond, I look at the issuer, the credit risk, the interest rate. What's my outlook for inflation, deflation? Lots of ways of analyzing it. If you buy real estate, what about the locations or tenant, the credit worthy? So there are ways of valuing all of these asset classes. But Bitcoin's not an asset class, and it's not an investment. It's just money. There's no Bitcoin bonds. You buy Bitcoin, you don't get 2% interest or 5%. You don't get anything. So when I give up dollars to get Bitcoins, if I did, I don't, by the way, I don't own any Bitcoins, but if I did, all I'm doing, I'm swapping one form of money for another. I'm saying, I want to get out of this kind of money and I want to get into this kind of money called Bitcoin. So when you see Bitcoin go from $1,000 to $2,000 to $3,000, what's really happening? I would say this brings up the problem of the numeraire, or what's the yardstick? How do you measure things? If you make Bitcoin the numeraire, so okay, Bitcoin is the measure of all things. 1 Bitcoin is my unit of measurement. So when it goes from $2,000 to $3,000, what's really happening is the dollar is going down. If you hold Bitcoin constant, say, well, it used to cost me $2,000 to get a Bitcoin. Now it costs me $3,000 to get a Bitcoin. What's really happening in that scenario is the dollar just went down by 50%. So, so the question when it comes to valuation metrics is when you see Bitcoin going from $1,000, $2,000, $3,000, one possibility is that people are losing confidence in the dollar. That if again, hold Bitcoin constant, you need more and more and more dollars to get a Bitcoin. So is that indicative of the fact that people are losing confidence in the dollar? Well, as a scientist, you say, was there any other evidence for that? We look around, if people were losing confidence in the dollar, it would be reflected in a lot of places. Gold would be going up, oil would be going up, real estate would be going up, everything else, Bitcoin and everything else would be going up. Except that what we have is Bitcoin is going up and everything else isn't. I mean, gold's going up a little, but all these things are going up a little, but they're not going up a lot. Bitcoin's the only one that's going up a lot. So that tells you empirically that this is not a generalized loss of confidence in the dollar or the euro or any other currency. I think that will come, but we're not there yet. The evidence that this is a generalized loss of confidence in dollars or euros or whatever is not there, because if it were, all these other things would be going up also. People would be getting out of dollars, they might be buying Bitcoin, but they would be buying gold and real estate and art and all these things. And the evidence is not there. Like I say, they're going up a little, but not a lot. So if that's not the explanation, what is the explanation? Well, there are 2 other explanations. One is the greater fool theory, which is that I'll pay $2,000 for a Bitcoin because I think there's some sucker who will pay me $3,000. And that guy says, well, I'll pay $3,000 for Bitcoin because there's some sucker that will pay me $4,000. That's called the greater fool theory. You buy them because you think there's a sucker who will pay you more. And that works until it doesn't. There comes a time when you're the sucker. The old joke, if you're in a poker game and you don't know who the sucker is, you're the sucker. Well, somebody's going to pay something, $2,000, $3,000, $4,000 for Bitcoin. They're going to find out that they're the sucker and the whole thing comes tumbling down. That looks like what it is. That's the second explanation. There's a third explanation, which is criminality. So drug smugglers, money launderers, terrorists, any kind of illegal activity, you would transact in Bitcoin because in theory you avoid government detection. That's what's certainly going on as well. I've done some work with United States Special Operations Command where we were studying and working on ways of interdicting and preventing the use of cryptocurrencies by the Islamic State in Syria. And there are ways to do that I can't talk about, but that's going on also. It's being used for terrorist finance, drug smuggling, money laundering, et cetera. So it's a little sandbox over here. The kids are playing in the sandbox. There's no evidence that this is a loss of confidence in other forms of money. So it looks like some combination of the greater fool theory and criminal. So that's your explanation for why Bitcoin's going up. Now, one interesting footnote, Valentin, I don't think very many people are focused on this. If you buy a Bitcoin for $1,000 and you sell it for $2,000, you have a $1,000 gain. You have to put that on your tax return, at least if you're a U.S. citizen, and pay taxes on it. And if you make enough money, it's like 40%. How many people buying and selling Bitcoin are reporting the profits on their tax returns? I don't know the answer to that. But I do know that if you don't, you're a criminal. This is how they got Al Capone. This is how Al Capone ended up on Alcatraz. It wasn't for bootlegging and murder. It was for tax evasion. So I have a tax background. I was the National Tax Counsel for Citi for 10 years at the beginning of my career. So I know a lot about how the IRS operates. They're just watching. One day they're going to wake up and they're going to find a test case, some individual, and they're going to hit some of these Bitcoin exchanges with a subpoena and say, give us all your books and records of all your accounts because we think there's major tax evasion going on here. And the exchange will say, hey, get lost, jump off a bridge. And the IRS will say, fine, they'll go to court, get a court order, shut down the exchange, freeze all the Bitcoins. Now this is exactly, something like this is what they did to US tax evaders who were opening Swiss bank accounts. And everyone said, I'm in Switzerland, you can't catch me. Guess again. The IRS went to UBS, Credit Suisse, and the other big Swiss banks and some of the German banks and others doing business over there and said, this is simple. Either give us all the books and records on U.S. taxpayers, or we're shutting you out of the dollar payment system. We're kicking you out of the United States. Well, these banks have bigger operations in the U.S. than they do in Europe. So they said, fine. They handed over the records, and people are going to jail. A lot of people are hiding, and a lot of people are trying to negotiate their way out of it. But the IRS can play rough when they want to. Just because they haven't so far doesn't mean that they're not planning to do that. So, and the other thing I just mentioned briefly is, people think they're investing in something. Well, as I said, you're not investing in anything. You're just swapping one kind of money for another. But remember, if you buy stocks or bonds, they're regulated by the SEC. The SEC doesn't always get it right. I'm not necessarily the biggest fan of the SEC, but they have rules, and people, by and large, play by the rules. But Bitcoin's not a stock. It's not a bond. It's not regulated by the SEC. It's, as I say, it's a form of money. So there's no transparency. How do we know? There's something called painting the tape. So how do we know that at the end of every trading day, somebody doesn't come in and buy one Bitcoin for $3,000, and that's the print, and everyone goes, oh, Bitcoin went up to $3,000. It doesn't mean everybody with a Bitcoin transacted at $3,000. It just means that one Bitcoin printed at $3,000 and they painted the tape. Well, if you did that in the securities market, you'd go to jail. But there's no regulation of these exchanges. Now, I'm not saying that is happening. I'm saying that could very easily be happening, and you would have no way of knowing. So, combination of our friends at the IRS, the fact that there is no securities regulation, looks like the greater fool theory. There is no evidence that there's a general collapse in the dollar. I expect that'll happen for other reasons at a different time, but not yet. It looks like a bubble, or I guess a sandbox for criminals.
Very interesting views on Bitcoin that I don't necessarily agree with, but we'll leave it at that. And thanks a lot for your commentary on gold and everything. Always a pleasure to have you. James Rickards, author of The Road to Ruin and the editor of the Strategic Intelligence.
Elected, and like a little bit after midnight, 2 a.m. on November 9th, it was becoming apparent that he was going to be the next president. The immediate reaction in the stock market, the Dow Jones dropped 800 points. This is in the futures in the middle of the night. Then Carl Icahn leaves the victory party at Trump Tower, goes out and buys $2 billion worth of stocks. You know, it must be nice to be Carl Icahn. And the stock market went up by the open on the November 9th. Market was flat. By the end of the day, it was up, and then never looked back. Now, the Dow Jones, you know, the same is true of the S&P, but I'll just use the Dow Jones. It went up about 1,000 points in November in the expectation of Trump tax cuts. It then went up another 1,000 points in December in expectation of Trump tax cuts. It then went up another 1,000 points in January in expectation of Trump tax cuts. There's only one tax cut. The market went up 3 times on the same tax cut. It was like, oh, well, they're going to announce details, or it's going to be in the president's address to Congress, or, yeah, there's always a story on Wall Street. But the problem is it was going up based on tax cuts, infrastructure spending. Remember the $1 trillion infrastructure spending, repeal of Obamacare, et cetera, et cetera.
Deregulation.
Deregulation. None of those things have happened. A little bit on deregulation, yes, but there's no tax cut. We haven't repealed Obamacare. There's no wall. There's no infrastructure bill. All the things that Trump talked about haven't happened. Now, will they happen? It's looking very doubtful this year. I mean, people want them to happen, but there's no agreement in the Congress as to what these bills, should look like. I mean, actually, at one stage of my career, I was a registered lobbyist. I ran a Washington office. We had a lot of, high-powered ex-Hill staff. I spent 2 or 3 days a week up on the Hill meeting with, Republicans and Democrats, members and staff. So I know how the machinery works, so to speak. It's not pretty. It is a sausage factory. But I also know that you can't just sit in the White House and pound the table and expect things to happen. That's not how things work, even when your party has the majority. So right now, you only got so many days left. The Congress has a schedule. They only, they have what they call legislative days. These guys women only work like 3 days a week. I mean, they go home to their districts on the weekend. They come back Monday night. They leave Thursday. So they're only working like Tuesday, Wednesday, Thursday as it is. Then they take, they have an August recess. Well, the August recess is like 6 weeks. It's like not a month. It's a month and a half. They'll have a 4th of July recess. So when you boil it all down, normal is, but somewhere in that vicinity. Well, you can't sell that many Treasury bonds. You destroy the market, rates would go up, you'd put the U.S. in recession, the housing market would collapse, and they're not going to. What they're going to do is just let them mature. So let's say 5 years ago, you bought a 5-year note, and you held it the whole time. Well, sometime this year, on the 5th anniversary, it's going to mature. The Treasury just sends you the money. And when the Fed gets money, the money disappears. It's like a mystical act, So the point is they don't have to sell anything. They just have to wait until the bonds mature. Now, what they've been doing now is you say, well, that's true. Why hasn't the balance sheet been going down? Well, the answer is they've been rolling it over. So when an old 5-year note matures, the Treasury sends them the money. They take the money and buy a new 5-year note so that the balance sheet remains unchanged. So what they're proposing is that when these securities mature, they won't buy a new one. They won't roll it over, and that actually will reduce the balance sheet and make money disappear. It'll reduce the money supply. Now they're saying they're going to do it, very small increments. Who knows? Maybe 10 billion a month or 20 billion a month that they won't roll over, so the balance sheet will come down by that much. They say they want to put it on autopilot. They're using the word, they always use jargon, they're using the word background. They say, we're going to run this on background. So while we're over here, raising interest rates or doing other things with monetary policy, this is going to be, humming away on background, like when you have 2 or 3 computer programs open at once and you're multitasking, you're looking at one and the other one's running on background. That's how they think about it. That's nonsense. I mean, they spent 8 years telling us that quantitative easing was stimulative, had portfolio channel effects, but now somehow we're supposed to believe that quantitative tightening has no effect at all. By the way, I don't think they're using the word quantitative tightening. I am. It's the evil twin of QE. So QE is quantitative easing, QT is quantitative tightening. They'll probably call it balance sheet normalization, but I think QT is going to catch on. So they want to run this QT on background, small increments, and pretend that nothing's happening. But that's nonsense. It's just one more way of tightening money in a weak economy, probably cause a recession.
So that's interesting that you say it will cause a recession, because the QE critics have said, yeah, it's nice, the stock market's going up, the bond market.
You've got to get them up to 3% in order to cut them back down, maybe to 0, to get out of the next recession. So that explains why the Fed is raising interest rates. They raised in December 2015, December 2016, March 2017. Now, June 2017, that's the 4th rate hike, getting them up to 1%. They would like to keep going. They would like to get them up to 3.5% by 2019. My estimate is they're not going to get there. The recession will come first. In fact, the Fed will probably cause the recession that they're preparing to cure. But be that as it may, that's why they're raising interest rates in weakness. But there's another tool. So let's just say, hypothetically, you get interest rates, they'll be at 1% by tomorrow, and now you go into a recession, and you've got to cut them, research shows, about 3%. Well, you can cut them back down to 0. Well, now what do? You go to QE, QE4. We had QE 1, 2, and 3 during Bernanke and Yellen, so now you could do a new round of QE. The problem is that the Fed's balance sheet is so bloated at 4.5 trillion. How much more can you do? 5 trillion, 5.5 trillion, 6 trillion, before you cause a loss of confidence in the dollar. Now, modern monetary theorists, MMT, people like Professor Stephanie Kelton, very nice, very smart lady, very nice lady, by the way, but we just disagree on policy. But Warren Mosler, Paul McCulley, there are a lot of really smart people who think that there's no limit on how much money you can print. Just print money, what's the problem? I disagree. I think there's kind of an invisible confidence boundary. I think the Fed agrees with me. They won't talk about it. No one knows what it is, but you don't want to find out the hard way. So in addition to raising rates so they can cut them, they want to reduce the balance sheet so they can expand it in QE4. So as I say, this is all a matter of getting ready for the next recession. They haven't said anything very specific about how and when they're going to reduce the balance sheet. They've signaled it, they've hinted at it, but I think we're going to hear a lot more specific information. Probably they'll start later this year. And the way they do it, people say, well, are you going to dump all these treasuries? You can't sell $4 trillion worth of treasuries. By the way, they probably do have to reduce the balance sheet at least $2 trillion. So who knows what normal is, but you probably want to get from $4.5 trillion down to $2.5 trillion, maybe $2 trillion. It's guesswork as to what normal. Great to be with you, Valentin.
So today we're going to be talking about some of James's core topics: Federal Reserve, gold, maybe a bit of China if we have time. So why don't we start with the Fed, since they're meeting tomorrow, Wednesday?
Well, the analysis with the Fed is very straightforward. Obviously, they're going to raise interest rates 25 basis points on Wednesday. Janet Yellen, the chairman of the Fed, will do her press conference in the afternoon, I think around 2 o'clock. She comes out. They have the so-called dots, which are the projections of the members of the Board of Governors and the Regional Reserve Bank presidents as to their expectations of interest rate levels going into the future. But the real news coming out of the meeting will be what they have to say about balance sheet normalization. Before the last financial crisis in 2008, the Fed's balance sheet was about $800 billion. Today, it's $4.5 trillion. That's how much money they've printed. When they print money, they do it by buying bonds from the primary dealers, and the dealers deliver the bonds, and the Fed pays for it with money that comes from thin air. But then the Fed owns the bonds, so they've got this bloated balance sheet. Now, what the Fed is trying to do, they're trying to prepare for the next recession. They're not predicting a recession. They never do. The Fed never sees a recession coming, but they know a recession will come sooner than later. This expansion is 92 months old. It's one of the longest expansions in U.S. history. It's also the weakest expansion in U.S. history. A lot of people say, what expansion? Feels like a depression to me. I think that's the right way to think about it. I think it is a depression defined as depressed growth, and we have growth, but it's below trend. Trend's sort of 3, 3.5, and growth is 2. That output gap between, say, 3.5 and 2, that's depressed growth. So I'd say we're in a depression, but we're not in a technical recession, haven't been since June 2009. So it's been an 8-year expansion at this point, but it won't go on forever, and the Fed knows that. So research shows that when the U.S. economy goes into a recession, you have to cut interest rates about 3% to get the U.S. out of the recession. Well, how do you cut interest rates 3% when you're only at 1%? The answer is you can't.
Market's going up, but the economy is not really going, so it hasn't done a lot for the economy. So why do you say that then the QT, which probably will reduce asset prices, why will it cause a recession?
Because of the same portfolio channel effect that worked in QE. This is, as I say, QT is QE in reverse. So, for example, first of all, the economy is weakening anyway. There's a lot of evidence of that. You see disinflation. The Fed has a 2% inflation target. There are a lot of different inflation measures out there, the CPI, PPI, core, trim mean, I don't want to get too technical, but lots of different ways of thinking about inflation. The Fed's favorite way, the one they focus on, is the personal consumption expenditure deflator core, meaning obviously excluding energy and food prices. So PCE core is the one they watch, and their target is 2%. They haven't hit the target. They haven't hit the target in years, but it was going up. It was heading in the right direction. Most recently, it backed off. So March, it was 1.6%. April, it ticked down to 1.5%. We don't have the May data yet. We'll have that soon. It'll be very interesting to watch if that continues, but we're seeing signs of disinflation. Auto sales are down. Loan originations are down. Inflation is down, meaning we're getting disinflation. Just a lot of signs that the consumer confidence is down, et cetera. So a lot of signs that the economy is slowing down. Anyway, now throw on another rate hike and some talk about future rate hikes, and then QT on top of that, you run the risk of deflating the stock market, and then that's kind of like watching the movie in reverse. So what happens when the stock market goes down? People's confidence goes down. A lot of the bulls point to consumer confidence as a reason the economy is getting better. That's nonsense. Consumer confidence is highly correlated to the stock market. So stocks go up, consumer confidence goes up. That's no surprise. Stocks go up more, consumer confidence goes up more. It doesn't mean that consumers are really spending more or retail sales are booming. It just means that they like their 401ks. But that works in reverse. When the stock market goes down, watch consumer confidence implode. So we have a lot of signs of weakness anyway. As far as the stock market's concerned, it's completely priced to perfection based on the Trump agenda, based on Trump's plans. So November 8th, Trump gets